Good morning and good afternoon, everyone. It is November 6th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this session and your questions may be recorded. Today we have Zhipeng Cai, China economist, Takashi Yamaguchi, Chief Japan economist, Gaten Ku, Asia Macro Strategist. During this podcast, you can send us questions at any time from the Ask a Question text box. Last week, we had the Xi and Trump meeting, and for now, we see marginally better tariff pass, but then we still think that US and China will still be in the competitive confrontation stage. Can I invite you, Zhipeng, to share team's takeaway from the meeting?
Yes, sure. Thanks, Crystal. So as you said, the deal is slightly more constructive than the market earlier expected, but we still call it a truce, not a deal. First, the framework agreement reached in Korea was better than expected. It is wider in scope. On top of this de-escalation in some non-tariff barriers, the fentanyl-related tariffs were cut by half. So that is somewhat exceeding market expectations. So it's definitely a slight plus. And then the agreement appears to be more durable in a sense that the agreement set many grace periods to be 1 year. So instead of a quarter by quarter kind of rolling update. So this is 1 year kind of a détente if no unexpected shocks arrives. And finally, both sides also appear to be quite pragmatic by reaping most of these lower hanging fruits in the bilateral trade relationships. So what does this mean? I think this framework agreement suggests that the US and China appears to have reached a strategic stalemate or balance or symmetry, whatever you want to call it. But basically, it means that not one side can hurt the other side in a lopsided or disproportionate manner, because both sides have mutually like a destructive kind of leverages. And with this agreement reached in Korea, basically China will continue to supply a sufficient, rare earth in exchange for critical US tech inputs for domestic tech to catch up. So both sides buys time to facilitate a continued long-term de-risking. And at Morgan Stanley, we call this long-term de-risking a competitive confrontation. There are three elements to this competitive confrontation. One, bilateral trade will be kept at a minimal or low level, subject to supply chain basically interdependence. Number two, the non-tariff barriers will remain quite high on tech, on export controls. And finally, the industrial policy is making a comeback, particularly in the US, with all these industrial policies supporting AI and manufacturing capex. And so the implication of this competitive confrontation is that do not rule out, potential mini cycles of escalations followed by de-escalations. Because the recent framework deal only touches on the low-hanging fruits, but the more difficult issues were either not addressed or requires further negotiations. So that kind of a dynamic or status, means that some potential escalations and the de-escalation cycle is probably going to be unavoidable. So that is why we call this framework agreement a truce, but not a deal. Now, both sides buys time. For China, it's about creating a relatively stable environment for the domestic tech to catch up. For the US, it's also probably about buying time to build up their alternative supply chain for rare earth, particularly for critical sectors. But China will need to utilize this spot time efficiently and effectively. So let me go to this 5-year plan outline, which was also released last week. This is also very much a tech-first, consumption-second kind of a policy framework, suggesting some kind of policy continuity. There are a clear sense of urgency to reach better tech self-sufficiency in this 5-year plan. For Beijing, it is quite clear and vocal to use a renewed national campaign to overcome some supply chain choke points in advanced semiconductors, advanced materials, pharmaceuticals, or these precision machineries. So these supply chain choke points will basically gain continued policy support and financial support in the next 5 years to increase China's tech self-sufficiency. But overall, this 5-year plan, outline, while it focused on tech, but on consumption, it also listed some clear goals. So which means that the overall 5-year plan may be more balanced than previously feared. Particularly, they mentioned to raise the consumption share in GDP. Whether they will have a numerical target or we can only know by March next year when the full 5-year plan will be released. But if they set a clear target, then if this the rise in consumption share is going to be quite constructive, then it will probably be very constructive in terms of the narratives on China, where Beijing is trying to fine-tune its policy framework and focus more on rebalancing the economy. So it's probably not just intention, but also some concrete actions to balance the economy incrementally at the margin. What they can do, they will use all these targeted consumption support for goods consumption, such as these consumption goods trading program, removing a lot of these consumption bottlenecks, such as car license plates applications. They will also incrementally strengthen the social welfare network. For example, gradually raising the rural pension payout to these 500 to 600 million rural residents. Also incrementally increase the social spending on public services or some targeted, fertility or early education support. So these incremental, welfare policies or public service spending will help China to gradually rebalance the economy. But given this starting point of a quite severe imbalance and quite entrenched deflation, we still expect, the reflation path to be quite bumpy, to be quite, dragging on. So in 2026 and 27, we still expect a slow burn in this reflationary struggle. GDP deflator will likely remain negative for next year, only emerging from deflation towards lowflation range from 2027 onwards. Yeah, I'll stop here.
Thank you very much, Zhipeng. We do have a few questions, but now I'll save it to the Q&A session. Now we will shift to Japan first. Yamaguchi-san, you see the December hike as the most likely base case now. Can you share the takeaways from Ueda's meeting and also the Japan monetary policy outlook?
Sure. Thank you, Crystal. Thank you, everyone, for joining. I'm Takeshi Yamaguchi, Chief Japan Economist in Tokyo. So Governor Ueda had a press conference after the October monetary policy meeting. And I think initial market reaction was that Governor Ueda's comments were dovish. And I have to say that, there are some, dovish elements in his comments, such as uncertainty about the U.S. tariff, U.S. economy still remain. But I think these comments, seemingly dovish comments, are mainly for explaining why BOJ didn't raise interest rates at the October monetary policy meeting. And if you look at the more forward-looking comments by Governor Ueda, I think there are lots of hawkish comments, or I think comments suggesting BOJ is leaning toward early rate hike. For example, BOJ said that Governor Ueda said that conviction in achieving the central outlook is gradually increasing, and also he said that the risk of the U.S. economy somewhat eased. That's another point. Also, he said that BOJ would like to focus on the initial momentum of spring wage negotiations, or shodo in Japanese, which is initial move, if you translate it literally to English. And I think this is a kind of a bit special word. And if Ueda-san said results of the spring wage negotiations, then BOJ would need to wait until March or April. But initial moves of momentum, this is I think pretty a special wording indicative of early move. So we think BOJ will likely move either in January and December. And in January, there's a regional branch managers meeting. So BOJ's board members can obtain detailed information from regional branches about the spring wage negotiations outlook. But I think Governor Ueda also said that the headquarters will continuously obtain information from regional BOJ branches. And there are lots of information, such as the labor union stance toward spring wage negotiations, or Japan Business Federation, the company's management stance. Also in December there will be December BOJ Tankan. So I think a BOJ can obtain companies' profits outlook or capex outlook in the data before the December monetary policy meeting. So overall, I think BOJ is preparing for the rate hike. And I think a recent, some local media articles, such as GG Press, also suggested that the BOJ is preparing for early rate hike in December. I think that this to our scenario, our base case scenario in December rate hike, is I think a political, I would say. So, for example, there's some risk of Prime Minister Takaichi-san dissolving the lower house to have a snap election. And recent polls show a pretty high cabinet support rate, 70% or 80%. So there may be some incentive for Takaichi-san to dissolve the lower house early during the honeymoon period. So if Takaichi-san, for example, dissolves the lower house in December to have a general election in the same month, then I think a BOJ would have to wait for the end of the election. So that I think a rate hike could be postponed to January. Also, I think there's another possibility that Takaichi-san dissolving the lower house at the end of December to have an election in January. In that case, I think a January rate hike would be difficult, and I think a December would be a more likely scenario. So I think we need to be careful about the political developments going ahead. And I think another interesting recent development is Takaichi-san appointing reflationary members to the Growth Strategy Council, which discusses priority areas in terms of government investment. And I think they in the initial first meeting they specified 17 priority investment areas. And these areas include AI and semiconductors, shipbuilding, quantum technology, synthetic biology and biotechnology, aviation and space, digital and cybersecurity, content industry, food tech, resource and energy security, green transformation, disaster prevention and national resilience, drug discovery and advanced medicine, fusion energy, materials, port logistics, defense industry, information and communications, and marine sector. So I think my point is that these 17 sectors will likely receive more budget allocation going ahead. I think more likely after the government officially finalize the growth strategy report, most likely in June 2026. So in the near term, supplementary budget, there may be some increase, but I think more meaningful increase will likely come in the next year's budget, 26 supplementary budget and 27 main budget. So I think these areas are pretty important from the viewpoint of the equity investors. So I'll stop here, and I will take questions later. Thank you very much.
Thank you so much, Yamaguchi-san. And last but not least, let me invite Get here to share her views on the Asia investment rates, given that now we have a less bearish dollar view now.
Yeah, sure. Thanks, Crystal. So yeah, we made some tweaks to our views on the US dollar as well as US rate side last week after the FOMC meeting, because Powell very clearly said that we would need to see more data in order to sort of go ahead with the December Fed cut. So which makes the December cut a bit more uncertain now. So on the back of that, actually last week we turned a bit more neutral on the US dollar, mainly because one of this uncertainty around the Fed and a potential pricing of a higher terminal rate by the markets, and two, because US growth has actually been quite resilient, and now because of the government shutdown, we don't really have any new tier 1 data that comes out, so it might actually keep this narrative around resilient US growth outlook going. So that could also change some of the hedging behavior among the corporates as well as investors generally on their FX hedge ratios. So that's why this combination of factors just makes us a little bit more neutral on the dollar, at least in the near term, going into the end of the year, thinking that there are not many catalysts that can really bring the dollar a lot lower for the next few months. But although in the medium term, we still think the dollar outlook is a bearish one, because there still could be policy and political risks that emerge in early 2026. And if we start to get the data coming out from early 26 as well, then that could also sort of show some of the slowing in the economic data that we're expecting, and hence bring the dollar lower. So what does this mean for the dollar Asia outlook? We think in the near term, at least, it's going to be difficult for dollar Asia to really go a lot lower as well. I mean, Asia currencies actually have been underperforming since the summer, because if we look at the performance of Asia currencies versus the rest of EM since July, actually Asia have really underperformed and weakened, mainly because of a couple of things, right? One is you have the very limited carry support here. In fact, the dollar is pretty much the carry currency against Asia currencies. And then two is also there have been some sort of policy uncertainty in some of the Asia economies as well. So now if we add on this factor that the dollar might actually stay relatively supported in the next couple months, then that makes it even harder for Asia currencies to do well. So we do think the risks for dollar Asia might be more towards the upside over the next few months as well, and in line with this sort of more neutral view in the dollar. So in terms of where we could see a bit more outperformance within Asia, though, we do think INR and CNH could be some that do a little bit better. So because for CNH, dollar CNH has been really stable since the summer as well, even through all this increase and then subsequent decrease in trade tensions, as well as the equity market rally. And part of the reason is because, of course, the dollar CNY fixing has been anchoring the currency, because it's just been drifting lower, which markets are taking it as a sign that the central bank would like to see a slightly stronger currency. So I mean, if we look at so that could sort of help to provide some anchor for dollar CNH. But also if we look at the capital flows, they've been relatively stable as well, where the trade surplus, for example, has been averaging around or hovering around $100 billion every month. And then equity flows, there's also been very little sort of inflows into the domestic onshore equity market, even through the recent rally, because a lot of the rally was driven by domestic capital. And then on the bond side, we've also seen outflows around like $15 billion every month, quite stable, aside from an increase in July. But then a lot of the flows on the bond side could also be FX hedged, because previously investors could get yield pickup if they buy bonds and then FX hedge it. So that might have less of an impact on the currency as well. So when we sort of look ahead, we do think the flows outlook is still pointing towards stability, because trade surplus could still stay around $100 billion every month, especially with this reduction in trade uncertainty, as Japan sort of mentioned earlier. And then on the equity side, because our equity strategies are sort of forecasting mid-single digit increase in the equity market. So on the index level, so that might not be really causing a sort of big shift in terms of the flows from foreign investors into the domestic market. And then on the FX conversion ratio front, that's where there's been a lot more focus among investors, because actually in the past few months, or rather since the second half of last year, we have seen an increase in exporters' FX conversion ratio. But what we've seen historically is that the FX conversion ratio for exporters is sort of correlated with the performance of the currency itself over the past few months. So if we look at the change in dollar CNY over the past few months, it is pointing to the exporters' FX conversion ratio staying relatively stable in the next few months as well. So that can help to sort of provide some stability for the currency as well. So yeah, with all these factors in mind, that's why we think dollar CNH may continue to be quite stable. So if we do get the dollar sort of strengthening, then CNH could do relatively better within Asia with this stability. INR is also one where we do think it can outperform tactically, mainly because one is there are media reports that the RBI has been increasing FX interventions to sort of smooth the volatility in the currency there. So that can help to limit the downside for the currency to some extent. And if we do get sort of the announcement of the trade deal between the US and India, then that could also help to support the currency as well in the near term. So that's why we think INR from a fundamental perspective, as well as a valuations perspective, because it is screening as one of the cheapest currencies within Asia. We think that can sort of help the currency to do a little bit better in the near term. Where we think currencies could underperform a little bit could be in places like Sing dollar, because it is one of the lowest yielding among the Asia currency complex, and so from a carry perspective, it looks good as a funding currency. But also if we consider sort of the whole environment of dollar staying relatively supported, dollar yen staying relatively supported as well, then Sing could be a bit more susceptible in that scenario because it has the highest correlation to these two pairs. So that's why we do think like from a funding currency perspective, Sing dollar could be one of the options there. And then on the rate side, on the US side, we've also sort of taken off some of the trades from our US team. So they have actually taken off the 3-cent steepener that they were previously sort of pushing, and also the long January Fed funds futures contract as well, mainly because of this uncertainty now around the December Fed cut. So what that means for the Asia complex, I think, is also sort of you get a bit more for Asia now. There's a bit more of repricing around the central bank easing policy as well. So if we do get this repricing for the Fed, then it sort of helps that momentum here in Asia. I mean, if we look at our own economist forecast, we are expecting the central banks in Asia to still be a bit more dovish than markets are pricing in. So near term, there could still be a bit of downside in terms of the yields. But we think it makes more sense to position for lower yields might be in places like China and India as well. So China mainly because if we consider some of the macro fundamentals, we do think the risk reward is more tilted towards a bit of modest decline in the yield side, mainly because one is the domestic demand conditions are still pretty soft, and then two is the equity rotation, the rotation of capital from bonds to equities. We think will be a bit less sort of significant than before, and also investors have really dialed back expectations of PBOC rate cuts, right? So we only see around like 3 basis points priced in now, and the PBOC could keep liquidity sufficiently ample in order to support the economy as well. So we think receiving rates in China on the 5-year point makes sense, although we do acknowledge that the downside will be quite modest because of the limited prospects of a near-term rate cut. So it's something going to be like a 10 basis point move. So that's on the China side. And then India, we also do think it's still a good carry trade to receive on the rate side, mainly because one is if we do get this trade deal announcement, then we could see a near-term bounce in terms of the India bond yields. But then, given that inflation is still quite low, and also the nominal growth conditions are still relatively soft for now, plus the RBI also sort of conducting VRR auctions and rejecting some of the bids at the weekly bond auction, suggests that yields could be also kept sufficiently low to support growth there. And then Korea has been the focus there in Asia rate space. So we do think steepness still makes sense in Korea, mainly because we're still forecasting a November rate cut from the BOK, which is not priced at all by markets at this point. So if we do get that, then we could get the curve to steepen. And if we don't get the BOK rate cut, we still think there's more room for yields to rise further out the curve than in the very front end, given that we already have quite a bit of hikes priced in for next year. So that's why we think steepener might be the best expression for Korea rates there. So yeah, maybe with that, let me pause there and hand it back to you, Crystal.
Thank you so much, Gek. And then now we are moving on to the Q&A session. There are several questions for Zhipeng first. The first one actually is more for the U.S. policy strategist, but then if you can share your perspective from the China standpoint, then it will be great. So because the U.S. Supreme Court currently is having a hearing the IEEPA tariffs, do you have any timeline and then also any uncertainty from here?
Sorry, I was on mute. Thanks, Crystal. So we don't have a house view regarding whether the Supreme Court will vote for or against these emergency tariffs. But let's suppose, it is deemed like unconstitutional and need to be rolled back, all these reciprocal tariffs. What does that mean for China? I think the US still has a number of channels through which they can increase the tariff levels on China. For example, they even said that they will continue with this 301, investigation on, whether China has been, fulfilling all these phase one trade deal, purchase agreements. So basically, this all going back to this competitive confrontation framework. The both sides will have basically the bilateral tariffs or non-tariff barriers between the two countries should be higher than, each country's, trade barriers versus the rest of the world, right? So the U.S. could still impose additional tariffs on China. So that's the, basically the outlook for the China's U.S. tariff rate on China. But for China's reaction function, if the U.S. increased tariffs on China through all these 301 investigations, China could also basically react in kind, increasing commensurately, the tariffs on U.S. exports.
Got it. That's super clear. Thank you, Zhipeng. Another question for you is how many years of leverage do we have on the rare earth front?
Yes, I think our materials team have done this research. Basically, it's about a 3 to 5 year kind of a window period, because China's right now have some competitive edge in terms of rare earth compound processing, not just the mining part, but also more importantly the processing part, and the technological know-how during this process. I think China does have some clear advantages on this. And for the US and its allies to replicate the supply chain, it will take at least 3 to 5 years. But of course, the value of China's rare earth card will diminish over time as alternative supply chain gradually builds up. So I think still China would leverage this rare earth card and try to extract the full value of it in the next couple of years.
Thank you so much for this. And then we have another 2 questions on the Japan front. There is news headline about the government potentially appointing the reflationary former BOJ governor Wakatabe-san to the government council. Yamaguchi-san, can you share some views on this? And then the next question is what are you seeing on the export front from Japan to US, and also any differences between tech and non-tech?
Yes, thank you for the question. As for the first question, I think the Nikkei reported, also other several media outlets, Japanese media outlets reported that the government is considering to appoint Wakatabe-san, former BOJ deputy governor, also Nagahama-san, chief economist at I think Daiichi Research Institute, to the positions of Council on Economic and Fiscal Policy, which is a government council to discuss macro economic policy, fiscal policy stance, and budgetary stance. And I think we need to see more, follow-up reports by other media, and also that I think a final decision will be made by the end of this month. But if the reports are true, then it could have some impact on Japan's fiscal policy stance, especially for fiscal 27 and beyond. So now this Council on Economic and Fiscal Policy set the primary surplus target on the Japanese fiscal balance, and I think this has been kind of constrained in terms of the Japanese government's ability to expand the fiscal expenditures. But I think if these deflationary experts join the council, then I think there may be some possibility of they are trying to change the primary balance target. For example, they may, adopt, different targets such as, debt to GDP ratio over the medium term. And that would put more emphasis on nominal GDP growth and the resulting, tax revenue increase. So I think we need to see more developments, media headlines by the end of this month and the formal announcement. But I think this could potentially have the fiscal policy stance, more expansionary fiscal policy stance, especially next year. And as for exports, I think U.S. tariffs on Japan have been reduced to 15% for reciprocal tariffs, and also all tariffs as well. I think these tariffs are relatively favorable to other economies, but in July and August, Japanese exports had a huge decline, especially in auto-related exports to the U.S. So Japan's U.S.-bound exports declined by 8% Q-on-Q to the U.S. And I think this mainly came from auto-related exports, because I think many Japanese automakers kind of increased the exports ahead of a potential increase in tariffs. So now there's a kind of reactionary decline after a temporary surge in exports. But if you look at the IT-related exports, it remains positive, maintains positive growth, especially to Asia. So I think this global strong investment in IT sectors, including AIs, seems to be supporting Japanese exports. And I think good news is that in the September data, we saw some signs of a pickup in US-bound exports, after tariffs were reduced. So we think this decline may be a temporary one. I think in the third quarter GDP, we will likely see a negative Q-on-Q growth, mainly because of this big decline in exports. But from the fourth quarter, October-December quarter, we think Japanese exports and real GDP will recover to positive Q-on-Q growth. So I'll stop here and back to you, Crystal.
Thank you, Yamaguchi-san. That's super clear. The last set of questions are for Gek. Firstly, do you see any potential impacts on dollar-yen from a potentially earlier rate hike to December from January next year? And then the second question is, with all of the committed investment into US from Asia, do you see the pressure on the Asian currencies, especially Korean won, for example?
Yeah, thanks for the questions there. So yeah, on the yen front, for sure, if we do get a hike in from the BOJ either in December or January, that would have the impact of supporting the yen, at least in the near term. But we also think we have to consider the dollar side of things, because for dollar yen, actually the dollar side of things usually has a bigger weight in terms of influencing the direction for this pair. So on the US side, because there's also some uncertainty over whether the Fed could actually get enough data for them to go ahead and cut in December. So we think this sort of uncertainty might also sort of prevent or limit how much yen can strengthen from that perspective. If we actually do get the Fed sort of staying on hold in December, then we think that could actually put quite a bit of upward pressure on dollar yen, because markets are still pricing in roughly 15 basis point of cuts for December for the FOMC. So that could actually sort of push dollar yen in the other direction. So that's why we think overall we would put a little bit more weight on like the global and the US environment. So US being so there's uncertainty around December Fed cut, plus the fact that we think the demand for in the currency space is going to be for carry, given this expectation of resilient US growth outlook there. So actually yen would also look a little bit more as a funding currency from that perspective. So that's why actually for dollar yen previously we were bearish on dollar yen. We were sort of suggesting short dollar yen, but we sort of taken that off now with the neutral return in the dollar last week, thinking that in the near term at least we could see yen staying weak. Although in the medium term, like we still think yen would strengthen, but just in the near term, like we think it makes sense to look for a bit of weakness there. So that's on the dollar yen side and BOJ. And then on the second part with regards to the investment deals impact on Asia FX. I think the key one really is Korea, is the new information that we've gotten in the past week. So actually our take is that the information that's come out from the investment deal between the US and Korea is actually quite positive for the currency, all else equal, because of a few points. So one is actually going into the meeting between President Trump and President Lee, they were actually sort of guiding towards a deal not being able to be finalized last week. But then ultimately at the last minute, they actually managed to reach an agreement. So on the investment deal, so that sort of reduces the uncertainty for the markets. And then two is the amount that they've stipulated, which is $20 billion annual limit on the investments from Korea into US. That's actually quite manageable, we think, because $20 billion is sort of in line with what the BOK has said they can raise in the market without sort of causing any market disruptions. And two is also, it's not clear whether this 20 billion is sort of like an additional investment on top of the usual Korea FDI to US, or is it sort of counted within the usual investments? Because if we look in the past couple of years, the average FDI for Korea to US has averaged around $26 billion every year. So 20 billion, if it gets counted towards the usual investment, then it's actually sort of in line with the trends we've seen over the past couple of years. And then thirdly, also this $20 billion is actually a limit, so it's actually the maximum. So it could actually be less than that. So that's why we think the construct of the deal is actually quite positive for the currency. But of course, the funding also matters in terms of how they get these dollars. So on the Korea government side, they've actually said they will try and get the dollars that's needed for these investments via dividends or interest from their foreign currency assets, or via sort of dollar bond issuance from the policy banks. So that actually also minimizes the FX impact on the impact on the Korean won market as well. So yeah, that's why we think it really, just like if we sort of consider the construct of the deal, like we do think it's actually quite positive for the Korean won, for example. So I mean, for the other Asia economies like Japan, like they've also sort of said it's more sort of loans and loan guarantees. So that's why we also don't think it has a huge impact on the yen itself. So I think that the issue is just that this is, if we consider this is positive for the currency, but then of course for Korea it's also dependent a lot on what happens with dollar yen. So if we are expecting dollar yen to stay relatively elevated for now, then dollar Korea might also sort of stay relatively elevated at this point of time before we can get a better outlook next year on the back of the flows outlook. So yeah, maybe I'll pause there and hand back to you, Crystal.
Great. Thank you so much, Gak. So in the interest of time, we'll conclude today's podcast here and answer the remaining questions offline. Thank you so much, everyone, for joining us, and do reach out to me and the team if you have any other questions. Have a nice day, and I will see you next week.